Join the mortgage expert Heath Barnes as he equips loan officers and real estate agents with innovative ideas and tools so you can adapt to the changing environments in the marketplace. Be inspired by stories from some of the top professionals in the mortgage world today as they reveal their secrets of what made them successful while gaining knowledge and insight about how they continue their success regardless of the market conditions. Find out how to build a team and scale your business. Get ready to be more productive while working fewer hours. Here is your host, Heath Barnes.
Welcome to another episode of Mortgages Reimagined. I'm your host, Heath Barnes, and I'm overjoyed to have our guest today, Miss Tammy Wittren. Tammy is a loan officer out of Portland, Oregon, with over 30 years experience in real estate and lending. She became a licensed realtor and assisted the nation's top real estate agent before becoming an award-winning branch manager at NFM Lending. You know, what separates Tammy from the competition is she's built this team of professionals and a community who both share her commitment to serve others. Her passion to serve others, both realtors and clients, has led her to provide free guidance to loan officers and realtors through mastermind, home buying seminars, and coaching programs. She's been both a student and coach for over 20 years and is a firm believer in the power of a growth mindset. Tammy also is very philanthropic. She's raised more than $500,000 with Habitat of Humanity, the ALS Foundation, Relief Nursery, and many more nonprofits. In her spare time, she enjoys reading, gardening, and spending time on her property in Oregon City with her significant other, Steve, and their beloved dog, Walter. Welcome.
Oh, that's so nice. That's a lot.
Yes. Good to see you again, Tammy.
Oh my God, it's good to see you, Heathy. Hi.
I love it. Oh, nobody calls me Heathy but my mama. Thank you for bringing that up. Only a few people know that. Hey, so let's jump right in, Tammy. So I love to hear. I don't think I've ever even heard, like, how'd you get in the business? I read through a little research. Yeah. You were a realtor, and so share with the audience what the beginning was like.
So I am a MSU grad, Montana State University grad. And I really thought, so all through college, I waited tables and, you know, that crazy stress. And I really thought I wanted to get into resort marketing. So my degree is in communications. And then I have a minor in finance and a minor in econ. And I knew I was going in sales. I didn't know what. And I was in Bozeman, Montana, beautiful little place. And I was graduating and I was like, you know, I think I'll sell real estate. That's a great commission job. I'll do that. And so I jumped into it. I was, 21 years old and very young. And, after about 6 months, granted, my expenses were real cheap. One of the top producing realtors at that time at the URI franchise, her name was Sue Fry, asked me to be on her team. And that's how it started. So I worked for her for almost 4 years. And, this was back in 88 when, the first fax machine happened, guys, at the end of 88. So we were making photocopies of pictures and making flyers that way. And you came to the office to get the key. And so I did real estate that way. And I think what it did for me is it really helped me understand what it means to excel at something. And I watched this woman who moved from California to Montana and started over with nothing and just had this grinding work ethic. And I learned exactly what I needed to be and what I didn't want to be. Right. So I made very little money and worked my butt off for all those years. And my husband at that time finished his graduate degree and we moved to Portland, Oregon. So get here, I get my real first big job in corporate sales with a resort here called Sun River. I did that for 6 months. We were buying a house and the guy that interviewed me, we were buying a house with was like, wow, I love this real estate. industry stuff. Have you ever thought about the mortgage business? So part of my job back then is I had to take the application from the client and get it to the lender. There was one of them, and we would get the appraisal ordered, and the appraisal took 90 days just to happen.
90 days.
90 days. So that was my job.
As a realtor, as an assistant, you would take the loan application to the loan officer.
Yeah. And then drop it off after. And I had, figured out kind of payments and all that. And so that's how I got into it. And so I started working for my branch manager, closed my loan like that Monday. The following Monday, I showed up in his office as his assistant, was his assistant for about 6 months, and then launched on my own.
Wow.
I looked back.
So one thing I heard you say is I found out from this realtor that you work for what you needed to be and what you knew you didn't want to be. And I'm curious, what came up for you early that showed you, okay, this is who I want to be versus who I don't want to be? Yeah. Because you were working for like the top agent in the US.
You guys, in the US at the ERA franchise in 1989, she won the world #1 production back then at like 85 million in this little town of like 30 million. Or 30,000. And here was that fundamental for me was that if I ever made it, I would share the winnings. I would not hoard them. I would share them with the people that got me there. And that was just I don't want to do this alone. I do it with my team. And one of my greatest accomplishments in my life isn't my production. It's that I have this team that chooses to work with me. And I pay them a really fair, good wage. And I love that, I have a couple people that have been with me 13, 14 years, a couple people 7, 8 years. But, also, Heath, I've also had my team walk out on me a couple times. So, learned a lot.
That's painful. I've had that happen as well.
I wouldn't redo any of it.
Yeah. Yeah. We learn so much when our team walks out, right?
Well, you hope you do.
Yeah. Well, you do. If you have any introspective and understand that you create everything around you, and if your team walks out on you, like there's something you get to look at, right? Well, it also builds like tenacity inside you that, man, I can do this, I can do this and I can rebuild, and it builds that confidence. So yeah, I just for our audience, can you just share like what your team looks like right now and just the size?
So it's funny. We just pulled our production. We're right now, like year to date, about 130 million. Okay. I have a front end team. So I do all originating, everything flows in under my name. I have a front end team that works solely on my loans. And I bring the loans in. They're our realtor contacts, and they take them from application to disclosure. So we lock and disclose them. Then they go to my back end team. So there are 4 people on my front end team and 2 people on my back end team. And then I have an executive assistant team manager who is, so important, secret weapon in this industry. And then I have a realtor contact front end. She's my realtor liaison. So that's
what do you spend 90% of your time yourself doing? Prospecting for new clients, prospecting agents?
Yep. Prospecting agents, getting ready for presentations to add value to realtors and clients. Kind of fun. I am someone that I can't have a totally fixed calendar because, I'm constantly brought in. I do all the problems, meaning any bad news, I'm the deliverer of that. Any renegotiations, I'm doing that. Want to call, we have set points where I'm interjecting in the fight. I'm their loan officer. I need to contact all the clients.
Yeah, totally.
And be in relationship. And I also want relationships with listing and selling agents, and I never want them to feel like they've been passed off. So I spend a lot of time with that. I have a commitment to my team that I'm contacting no less than 15 new realtors a week. And then I validate and show them my work. I'm contacting and asking for reviews.
Yeah.
I'm accountable to my team.
Yeah. For those listening, and, somebody would say, well, you've got a big team. How does a client not feel passed off, right? How do you stay connected with the client and they feel like you're still involved? Like, are there a couple things that you do?
Heath, that's such a great comment. And here is my answer. This is how I live my life. It is not about ego. It's not about me. I don't sell the Tammy Wittring team. It's the Wittring team. And it is a team because I am great, but I'm a cog in the wheel. Together, my team and I deliver exceptional customer service. I cover nights and weekends for my team. Their ass is in the seat from 7:30 to about 6 every day. I swear to God, many of them have catheters because they just are not screwing around. Yeah. And, clients need cost estimates and they need to talk to you when they need to talk to you. And so my front end is actively in that. Every client has my cell. They can call me. I will pick up. I will answer. Yeah. But what we also know is that the J.D. Power Customer Service Award they have drilled down what customer service means. And customer service isn't about you being the be all, know all. It's about the client being served. And that means something different to everybody. But it really is 2 touch points. So I have my front end, my back end, and I come in. Right? So to keep consistency in communication, I can't override them. What I am doing is we share all communication, all emails, et cetera. I have a bunch of consistent emails that go out through the process. And then I pick up and follow up with a text or a call. Do you need me? Do you need to talk? I just don't find that clients do. But again, remember, I do cover nights and weekends. So I talk to everybody a couple times on the weekends.
Yeah. So what I hear you saying is you're touching them, whether it's texting or calling, saying, hey, do you need me? Do you need me? So that they feel like you're still there with them in the process. But
we're also very clear about the expectation. You're using my team and I because of the level of service. Like we are available. I sleep for about 6 hours. That's about all. I'm not available. I am committed to this. My realtor, I've been doing this real long time. Yeah. My realtors know I'm available and I'm going to get stuff done. And part of my sales pitch is, I help offers get accepted because of my name, because I am doing the amount of presentations. And I did not let up a bit in COVID when it comes to my presentations. I do some sort of presentation weekly to realtors. Okay. And I do an economic summit. I get, 100 and some realtors 3 times a month to those. So, I am out there. My name is visible. I'm in it, doing it.
So right now, when you're giving those presentations, I heard you earlier talking about providing value to not only your agents, but your clients. So, rates are going up. How are you providing value to your agents and your clients? Because most people are in this environment. They're super scared, especially if you're a newer loan officer and they've never been in an environment where rates are this high. You've been around a long time. You've seen this. So what are you communicating to not only your team, but mainly to the realtors and your clients about interest rates?
Yeah. Heath, I might go off on a little rant for just a sec, but I'll make it quick and try to get to the point.
We got time. We like rants. We like people that are passionate about what they're talking about.
I want to remind everyone that the pandemic hit, right? March. We were all there. I remember the date, the 17th, right? Yeah. But it had a buildup, and it started the quarter before, and people don't realize or remember this. We have a short-term memory. Rates had ticked up to almost 5%. We are at 4.875. I locked someone at 5.25 back in 19 fourth quarter. China shut down. Yeah. We weren't told about it. They shut down a month early. We got our reconnaissance going. We figured out they were shutting down, and the Federal Reserve was like, oh my God, this is going to be a big deal. We need to intervene. And they quit increasing short-term interest rates, which we had finally recovered, and they were doing it. They put a halt to that and dropped rates. And that started it. And then, as you remember, we started January and we were all like, what's going on? The media was unclear with us. February happened and we all started, people were getting sick. Okay. Now, here's what I want everyone to remember. Global pandemic. Only time in world history, the entire world has shut down. Not even in the Spanish flu, the plague, has the entire world, because we are a global world. So for someone to believe that we are entitled to interest rates that happened because we had a global pandemic, they need some more education and information about why interest rates dropped to 3% or lower. You guys, the world shut down. We were on life support. There are industries that were so vital to world function. The airline industry, for example, that has a cash burn almost $20 million a day, that was in jeopardy of imploding. The amount of intervention from the 162 countries out there was unilateral, and everybody came to the table. That is the only reason why interest rates dropped that low. Period.
And I don't think people even know that right before they dropped, right? They actually spiked. They went up. I'm sure they went up 1% in a day. Yes. Right? In a day, 1%. Yes. And the only reason they failed is because the Mortgage Bankers Association went to the feds and said, y'all get to do something about this. And they started buying mortgage-backed securities, and the rates just fell off a cliff.
Well, and I will tell you that. So in 2008, when the Federal Reserve came in and did quantitative easing, it was a very new phenomena. It was done in China and done in, I think, Czechoslovakia at that time. It was not a known economic, it was a theory. So we realized where we screwed up in 2008, what the Federal Reserve, if you go back and read, all the minutes said they should have came in with guns a-blazing to get the economy back in 2008 recovering faster.
Yes.
We delayed the whole thing by almost 3 years because of their slow willingness to come to the table and do quantitative easing. Quantitative easing is not the dropping or increasing of the Fed's fund rate. That is overnight banks. That reduces prime. There's only so much room you can do with that. Quantitative easing is when the federal government steps in and buys mortgage-backed securities off the market and holds them on our balance sheet. When people say the feds are printing money, that's what they mean. They held back all this inventory. Now, remember, supply and demand. So if you want someone to buy something at a 3%, people know that they're never going to refinance off of that, right? That's a very weighted commodity. That in turn, if the market wasn't buying it, that rate would have increased. So the Fed stepped in and purchased that. During 2008, that financial crisis we had, the Great Recession, we bought 4.9 trillion worth of assets. We are now at 9 trillion worth of assets. Okay, that the Federal Reserve bought through quantitative easing to get to the place that interest rates were that low. So again, Heath, what am I communicating to all my people? That was a once in a lifetime thing. We were not entitled to it. And because of it, I'm almost done. Because of it, we had an influx of buyers that normally would not qualify, right? Someone with household income, very low, what you and I were used to in our normal business, was qualifying for a home loan.
Now, the quantifying the easing, quantitative easing continued since 2000. It never stopped.
Ended in November.
They literally tried to stop it in 18 and realized
and they could not.
They couldn't. And so people don't realize this has been going on since 2008.
Keith, we just stopped. The Federal Reserve just stopped purchasing in November of 2021. So we headed into 2022 not buying those. So just because of that, interest rates were poised to go up. And they did. Now, the feds are also now pushing mortgage-backed securities to the tune of $49 billion a month back off the balance sheet that the market is absorbing. And so we have this supply and demand thing that's happening. But the one thing I want to remind folks, so the Federal Reserve has 3 mandates. Secure unemployment. We don't want to see unemployment lower than or higher than about 5%. Their average is between 4 and 5. We're now down about 3. Remember, it got to 14%. That's why they stepped in. They're to stabilize interest rates. Honestly, they're stabilized. They're not up and down every day, right? And then third is to make sure that overall inflation is under control. And that's why they're stepping in. Inflation is wackadoodle, but let's talk through the mechanics of that. Why is inflation so high? Inflation is so high not because of anything that the Federal Reserve or happened in the US. It is because of the Russian-Ukrainian war. 40% of commodities, food and energy, are the most volatile commodities that change the CPI number, not core inflation. Core inflation throws those out. Core inflation is not as high. It's the CPI, Consumer Price Index, that is so wackadoodle because it includes those inflationary numbers. You guys, until the Ukrainian and Russian war is over, we have inflation. The feds only have so many tools. You look around the globe, there is not a country that is not increasing interest rates. They're all doing it, and we're all doing it together to try to get a handle on this.
Yeah. And speaking of inflation, I was talking to a client just the other day who was thinking about, well, should I buy? Rates have really moved up. And I had this discussion with them. I said, well, would you rather have a 3% interest rate with 2.5% inflation, or a 6% interest rate with 8.5% inflation? Now, when they say 8.5, like the government says 8.5, do you really believe it's 8.5? Or do you think that's the lowest number they could get away with proving?
Well, yes.
I suspect it's probably much higher, right? And last year, housing went up like 19%.
24% so if you look, on average through the Schiller numbers.
Yeah. For those loan officers that are listening, that are thinking, okay, well, how do I share, with my clients to take a 6% interest rate? All they have to do is think about, inflation. And that means your house is going up 8 or 10%. So would you rather have 8 or 10% growth with 6% interest rate, or 3% growth with 3% rate? So
Heath, I love this statement. Let me just roll back a minute, because I think you just hit the fundamental for all of us. And I always remind people, and this is kind of the grounding of all this. So home is like 3-pronged, right? We want our home paid off when we retire, because you can retire in America when your home's paid off. So we take a 30-year loan, it's affordable, and people over their lifetime pay the loan off. So let's not forget the fundamental of home ownership. And that is first and foremost to pay your loan off. Okay. So with that, interest rates, is it an increase if it was a once in a lifetime phenomena that caused them to increase, or are we just now back to normal?
Yeah.
But anyway, okay. So with that said, why we buy a house is it's not a car. It's not an RV, right? It is a appreciating asset almost everywhere in the world. Now, in the US, just at 4%, let's do this math. At 400,000, 4% per year appreciation is $16,000.
Yeah.
Appreciation is something, it's a passive activity that happens through home ownership. You do nothing. When we're talking to clients, are they saving $1,200 a month? Typically, they're not. This is a passive thing happening. Not only are you getting to retirement because you're paying that asset off, right, to arrive here, but you're also acquiring $16,000 per year, compounded. So in 5 years, it's $86,000. You start doing the math. This is how leverage works, and it's fundamentally how wealth is created in America. So pay your mortgage on time, off, experience the appreciation, and then home is something you have to live in anyway. Unless you're going to do like people do in Portland and you're homeless and you live in a tent.
Right.
So you're going to either pay someone rent, and we all know rents are increasing. It's becoming very, very restrictive in Oregon and Southwest Washington with rental laws and rules and stuff. So you got to live somewhere. You either pay someone else or you bite the bullet. And what I will tell you, I do a post-closing interview, and I try to do it with my clients about 3-4 months later. And I'm always curious to ask, how hard is it to make the payment? It was really tight. I know you were struggling. And it's funny how most clients are like, there's some pride that's happening every month, but I've cut a few things and, I've now got a raise. And when we talk to clients, what we're not factoring in is typically a 3% appreciation or a 3% raise. I mean, even the federal government gives Social Security a 3% raise.
Yeah. Yeah.
That was
I think people should also realize that, the way we look at money and mortgages is different now than it was 30 or 40 years ago, where our parents taught us we need to put as much money down, finance it for a shorter period of time, and pay it off as quickly as possible. And that came up because mainly their parents back in the 30s and 40s, the bank would come and take your house. Well, that's not happening anymore.
Yeah.
Right?
Well, and the mortgages were very short term back then.
Yeah.
Yes.
So I think if the listeners or even the loan officers or clients or whoever's listening can think about, like, interest rates matter, but what also matters is the rate of inflation and figuring out what else can you put your money in besides your home, because your home's going to appreciate no matter what. Right.
And diversification. You guys, if you Google this, U.S. property appreciation and U.S. stock market, you can get a graph that will show you the last 100 years that the trajectory on that graph is about like this.
Yeah.
Yes, there are some bumps, right? But overall, home, stock market, solid investment value, right? So I just think, yes, there are going to be highs and lows, just like in life. It's a season. Hang on. Don't sell when it's low. Hold. Take a deep breath. Get unemotional. Heath, I also wanted to, as you were talking right there, diversification is something that we all need to think about. You don't want all your eggs in one basket, correct? Right. And home is one. I like to think of it as a stool. Either it's a 3-legged stool or a 4. Home, your investment in the stock market. Maybe you do crypto like you, and you do something else, something that you know yourself. And that's how you get a solid retirement. The other thing people need to remember too is mortgage insurance is such a gift. Now, mortgage insurance is an insurance, and clients by law, they are only required to make 24 on-time payments, and then they can petition the servicer to get it removed if they have a 22% equity position.
So now, it is 2 years, right?
It's 24 on-time payments and that 22% equity position. It's an insurance rule in law. They don't talk about it. Obviously, when you sign your PMI document at signing, it gives you the amortization in 11 years that it automatically comes off if you're, it varies with 3, 5, and 10% down. But you guys know the rules about mortgage insurance and articulate that to your clients, because it really typically, doesn't make sense when you could keep your money making money.
Yes.
You could have a little mortgage insurance, suck it up for 2 years if the market's appreciating, and use a very low appreciation rate and see if you can get there. So, I don't know if
you've experienced this, but I had several clients that put even 3 and 5% down that are calling me a year later.
Oh my gosh.
Wanting to have their MI removed. I'm like, you got to wait one more year, but it's not that much. No. I mean, most, we're trained. Our future is usually dictated by our past and learning things in the past. MI used to be out of control. Now it's very affordable now, and it's tax deductible.
Yes, it really is.
I give people the option. Hey, look, MI is only, $30 a month. Keep 70, your cash.
Even if it's $150, it's still better to keep your cash or borrow from your, just look at your options, and hopefully your loan officer is really digging in and, seeking to understand what your goals are financially, where you are personally. I mean, there's kind of this conundrum with a lot of folks about student loan debt and stuff. Do I pay that off? Do I do this? And I think that needs to be a conversation in all this.
Yeah. And as the market changes, understanding where to put your money. I mean, right now I'm even telling my clients, hey, listen, it's a great time to put your money as an investment property. Right. Yeah. I mean, with high inflation, I mean, if you've got most of the hedge funds out there buying single family residence because it's a good hedge against inflation, it's probably a good idea for you. In fact, I don't know if you know this, but I was at a poker game last night with some friends / agents of mine, and they were telling me that hedge funds are still buying single family residence at full price and then reselling them 2 or 3 months later at 5% over what they paid for them.
Yeah, that's crazy. Heath, I would love to segue as a value add for your people out there. We're talking all about, oh my God, the buyers are suffering. And the truth is, sellers are suffering. And somehow social media has made everyone feel like a loser if they're not 100,000 over on the sale of their house and got 10 offers. And if a buyer didn't get an interest rate of X right. But the truth of it is that the market has shifted. Yeah. And with that, sellers are still getting fair market value. They're just not getting the bonus income. And you and I both know, Heath, we're on commission, baby.
Yeah.
It's a bonus.
Yes.
Can't count on it. So
totally.
The market has not slipped. And, but the great thing about it is that buyers had this low interest rate, but in my marketplace, it was offset because we had to have an appraisal waiver on everything. Yeah. Buyers had thrown away the opportunity to negotiate repairs, many times foregoing a home inspection. In addition to that, they were free rent back for the seller for 60, 90 days. They were still paying their rent. And the list went on and on. So now if we just pause and we think about the things the buyers are getting, they're able to negotiate maybe a seller credit. And we're talking to people about buying out the mortgage insurance, but here's a caveat to that, you guys. If there is some sort of slowdown in the future and rates dropped a little bit, it doesn't make sense to refinance someone if they buy out the mortgage insurance, right?
Yeah.
So make sure you think that through. But, if you get a big old seller credit, there are all kinds of ways to spend it. Maybe you do half up front, the old days of splitting mortgage insurance premium. You look into that. But if a buyer can get any negotiation on repairs, not doing an appraisal waiver, not overpaying for a house just because they had to, that alone, the mitigation of the $600 payment increase if people go back to the lowest rates, it really is shifting. And I like to call it equalizing. I never said it was fair, but it's equalizing.
Yeah. You talked earlier about seller credit. Here's some things that are happening also in the market that people should consider. And it's a good way to contact listing agents. But as the market starts to shift and as interest rates rise, as a seller, if you give a discount on the house, you should think about giving it as a discount in points rather than taking it off the price. Most people would rather have a $10,000 discount in the price, but as a lender and as a buyer, it makes more sense to take that $10,000 and drop your rate a half point. And if it's a true payment from the seller,
dollar for dollar, it's more productive for a home buyer to take a $10,000 credit into the transaction because of the loss of future earnings on that money than it ever is to do a price decrease. $10,000 is $100, big deal.
Yeah. It's not much on your payment.
No, it's not enough. And you would have to save forever and ever. So get a credit for closing costs. But remember, if you have a big fat credit and you can't eat it up, mortgage insurance paid up front, those kinds of things need to be brought into the conversation too.
Yeah. What I'm hearing you say is even though we're in difficult times and times are changing, we get to adapt and we're going to find ourselves coming out of this even stronger. So as someone that is an advocate of a growth mindset, what would you say to our listeners out there that are concerned about the market and moving forward, how do they maintain a growth mindset or a positive mindset through this?
Well, first and foremost, if you're manifesting fear, your actions are fear driven. You tend to shut down and not do the work, right? I would tell you that now more than ever, realtors need great loan officers who are experienced, who are in the game actively. You guys, a lot of folks stayed in this business who are just riding out the refi volume and they're going to retire or get out. I promise you. Realtors are hungry for service. They're hungry for education. They're hungry for someone to partner with them and help talk clients off the fence and be a point of reason. I am dumbfounded how easy it is to pick up the phone and call agents and say, I would really love to reconnect. We lost touch. Are you available? And they're like, oh my God, I would love to have coffee. And then where are you? What are your pain points? What are you struggling with? Realtors are in the same struggle we are. More leads. How do we do it? Going back to the basics, all of it for everyone. Calling past clients. I am dumbfounded. In my coaching program I run with NFM, I was dumbfounded last week. 11 students went around the horn on both calls. How many of you are contacting your past clients? Not one raised their hand. And the reason they said they weren't is, why would I? I already refinanced them. What good are they? Oh my gosh, you guys, my past clients are worth a referral. If I close a loan, get a review first and foremost. Do what I say, not as I do. I'm working on my reviews hot and heavy and have 30 extra reviews. I'll get to 60 by the end of July, promise. But anyway, get a review from your clients. But that client is worth 5 referrals over the next 5 or 10 years.
Yeah.
Why wouldn't you? Every time we send a postcard out, our phone rings off the hook.
Yeah. And some people say, well, I don't know what to say. Well, why don't you just call them and say, hey, I just thought I would reach out because you're a previous client and I don't know what to say, but how's the house? People would rather you reach out. Some people don't have someone reaching out to them, right?
So loan officers, let me just remind you, and this is great fodder for your realtors to remind them. When people think of their advisors in their life, they have a physician, typically women do. They have a CPA, they have a financial advisor. People have a realtor and they have a loan officer. If you are someone's most important resource for their most important asset, you have earned the right and the privilege to call the client and say, hey, I'm just checking in as your loan officer. Do you have questions or concerns? And they may say, oh my God, the sky's falling. And you come in and you say, no, it is not. Yeah. This is okay. We're going to weather this. And it's a great opportunity. And yay, you have a fantastic rate. Can I help you with other questions? Yeah, totally. No, I agree with all that. And as we start to wind this down, what came to me is, in this new environment, I think for loan officers, if you want to make a shift in your business, be in responsibility, meaning that everything that happens in your business, just for me, this happened yesterday. We literally missed the closing and called the day before. And so I literally told my team, I got my team together. I said, listen, I want each of you to come up with 3 ways of why you're responsible. All 3 people on the team, why you're responsible. And we're going to put a letter together and we're going to send it to the client, the seller, and both agents. And we're going to do this from now on because if we miss a closing, we impact people's lives. We get to be responsible. I love that, Heath. And here's the thing. Some of my best relationships, they're not from doing what I'm expected to do, which is closed on time as promised and to be the expert. No, it's the character I've developed and created through hard times, delivering horrible news where I've screwed up, and I've delivered it sooner rather than later in a way where I'm not blaming anyone and I just own it. And I say, look, I wish I had someone to blame, but here's how I screwed it up. But here's how I'm going to fix it. I will call the listing agent and tell them it was my fault, not your fault, not the buyer's fault. I own this. I will do it. If my company will do a credit for the seller's PITI, we can do a lender credit, which, we can take off the credit you have. There are ways to show that you're an active participant. We all make mistakes. Owning it builds character, creates a reputation of being a solution-driven loan officer. Problems happen. It's never that they don't. It's how you respond.
Yeah, exactly. And those you think about the closest relationships in your life. You've had difficult situations and you've talked through it. It's not the relationships where nothing's ever gone wrong and you closed everything on time. And that's not a relationship. That's a conditional relationship. As long as you close loans on time, I'll send you business. Those I think many loan officers think I close every loan on time, and it's just not true. I mean, not everyone closes everything on time.
Well, I can say we close on time as promised because I get the transaction in and then I get the appraiser to comment on when he's coming back. And then I call everyone and go, yo, this is out of my control. Let's change it. So, the moment you even when you have that gut feeling, just do it. Semantics, call everyone.
Yeah.
They just want to know. Heath, people are hungry for us to be connected, hungry for you to be the professional you are. People want to help you if you let them know how.
Yeah.
I promise you, as loan officers out there, your clients don't understand that you are a referral-based business and that you need them to refer you. I promise you, 90% of them do not understand that.
Yeah. So for those listening, if you want your business to look like Tammy Wichron's business, learn to be in responsibility and take care of your clients. So I love that about you. It's a sign of why you've done so well and why you're a leader in the industry. And I appreciate your time. If our listeners would like to contact you, what's the best way for them to do that?
My email at NFM. And so it's complicated, people. My last name's hard. It's Wittren, Wittren at nfmlending.com.
So I'm curious, Tam, do you have any books that you can recommend to our listeners that you love?
Oh, I'm so happy you asked. I do indeed. My favorite book for mortgage folks is Pound the Stone, Joshua Metcalf. Love this book, little parable, so fun, but the lessons are just great sales lessons. Okay, just love this book, love it. It's sort of a little sales Bible I use in coaching. And then my friend Patrick Galvin, he's actually in Oregon, Portland area, wrote this book. It's called The Connector's Way. This is a great realtor book too, super fast. It's this tiny. People call it a bathroom book. And it is a really great book. Talks a lot about LinkedIn and connecting your realtors. And I would leave you with this value add. If you really want to become a partner with your realtors, the one thing you can do for them is advocate, elevate, and edify them during the transaction to the client. And if you really want to send it home, ask for a referral on their behalf.
Wow.
Honestly, what do realtors want from us? They want us to give them a deal. You want to do something for them. Just be an integral part of the growth and development of their business. And you will, the old Zig Ziglar, help enough people get what they want. You'll never have to work a day, right? You will have more abundance than you need.
Yeah. Well, there's no wonder why you've been so successful in the business, because you're putting other people before yourself. So I appreciate that about you. So thank you so much for being on the show today, Tammy. I hope to have you back for sure.
Awesome to see you.
I love being around you.
I love you too. I can hardly wait to see you and Cynthia. Come to Oregon.
Yes, for sure. Take care.
Bye, baby.
Bye-bye.
Thank you for listening today. Hopefully this discussion inspires you by providing new tools to shape your business so you can become a more innovative and cutting-edge professional in the mortgage space. Join Heath in more conversations with the industry's top leaders by subscribing to the podcast at www.heathbarnes.com. That's www.heathbarnes.com.